If your DSCR loan hinges on best case rent, your deal is one appraisal away from falling apart. Today, I am showing you the 5 mistakes that silently kill cash flow and exactly how to fix them before you ever submit your loan. Hey, I'm Eli, the DSCR Pro, and I help investors like you understand the market, find smart loan options, and turn today's challenges into tomorrow's cash flow. Watch until the end because I will reveal one simple tweak that can lift your DSCR by 0.2 to 0.3 and save a borderline deal. Mistake number 1, overestimating rent. The number 1 DSCR killer if your pro forma uses the top 10% of rents in the area. You're setting yourself up to miss. Underwriters don't care about your dream tenant. They care about market reality. Do this instead. Pull rental comps from multiple sources, MLS if you have it, public listings, Remoter, Zillow Rent, average them and underwrite to the average or even the low number, not the high number. In New York, New Jersey, and Connecticut, micro-location matters. A 3-bed near the Yonkers station won't comp like a 3-bed farther out. Jersey City Heights isn't the same as Outer Bergen. Bridgeport isn't Fairfield. Quick example, a 2-family in Jersey City Heights shows $3,200 to $3,600 per unit online. Underwriting $3,250, not $36. That 350 swing per unit can move your DSCR from 1.12 to 0.98. The difference between approval and a retrade. Mistake number 2, ignoring the DSCR threshold and the levers that push you across it. Most lenders want DSCR loans at least 1.0 to approve, and 1.5 or higher is usually where pricing and terms improve. Don't submit blind model your levers before you send the file. Your toolbox is simple. First, interest only. Dropping the principal portion offered bumps DSCR by 10 to 20 basis points. Second, a 40-year term with 10 years interest only. Spreads principal further and lowers the payment. Third, buy points for a lower rate. Yes, it is cash up front, but sometimes it is the cheapest way to cross the line. Fourth, raise the down payment if that is cleaner for you and your returns. Tri-state example, on a Bridgeport duplex, you're at 0.94 fully amortized. Switch to an interest only, add a small buy down, and you are at 1.08. Deal saved without bringing an extra $40,000 to closing.
Thank you very much, sir.
Mistake number 3, choosing a prepayment penalty without an exit strategy. DSCR loans typically have prepaid penalties from 0 to 5 years. Lower prepay usually means a higher rate. Trouble starts when you grab a 5-year prepay for the lower rate, then want to refinance in 18 to 24 months if rates drop or NOI jumps. How to choose? If you are adding value, renovations, lease apps, ADUs, and plan to refi, consider 1 to 3 years of prepayment to keep flexibility. If it is a stabilized long-term hold with strong cash flow, 5 years of prepay might be worth it for the rate savings. Always run both paths, the rate difference versus the cost of exiting early. Example, a stabilized 3-family in Yonkers with reliable tenants could justify 5 years of prepay. A fix and rent in Newark with big NOI upside goes shorter so you can refi after seasoning without writing a big check. Mistake number 4, underfunding reserves. Reserves are not cash into the deal. They are your stability mode. Lenders may want 3 to 12 months of PITI, depending on the case. Even if the lender wants 6 months, I recommend keeping 9 to 12 months liquid across your portfolio. Vacancies, unit turns, tax reassessments, and insurance hikes aren't if, they are when. Connecticut example, property taxes in parts of Fairfield County can shift after purchase. If you underwrote tight and didn't budget reserves, a reassessment can push your DSCR loan below 1.0 overnight and force tough choices. Mistake number 5, picking the wrong property type for DSCR loan guidelines. Not every lender treats short-term rentals, condos, mixed use, or 2 to 4 units multifamily the same. Guidelines vary a lot. Rules of thumb: 2 to 4 units beat single family for vacancy risk. 1 empty unit in a fourplex is 25% vacancy, not 100%. Condos can be great, but watch HOA's dues and warrantability. A high HOA plus rising insurance can crush the DSCR loan. For short-term rentals, some lenders haircut seasonal income or require specific data sources. Mixed use can cash flow well, but verify rent roll and zoning early. Tri-state examples: a Queens condo with a $900 monthly HOI can drop DSCR loans from 1.10 to 0.96 on paper. A New Haven triplex with solid 3-bed layouts near a hospital corridor usually offer more resilient DSCR loan. And Asbury Park, short-term rentals near the beach might gross big in season, but pick a lender who credits that income properly, or run a hybrid strategy and lock a 12-month tenant in 1 unit for stability. This is where most headaches start. The 3 biggest complaints I hear from borrowers are: 1, lack of communication. Files go dark, updates are vague, and you only hear about issues at the 11th hour. 2, lack of knowledge. Basic DSCR loan mechanics, STR income treatment, condo and HOA impacts, IO and 40-year structures, poorly explained or misunderstood. 3, not specializing in DSCR loans. Some lenders try to force agency or conventional logic onto investor deals, which leads to denials, pricing hits, or wasted time. What to look for instead? A lender who proactively models DSCR loans with multiple scenarios, explains prepay options and exit path, knows tri-state nuances, and still lends nationwide, and gives you a transparent milestone timely for disclosures to clear to close. If you feel like you are educating your lender, you are with the wrong one. Bonus: the simple tweak that lifts DSCR by 0.2 to 0.3. Lock your insurance early and shop it hard. Many investors estimate too high based on rumors or too low based on teaser quotes. Binding a competitive policy before you finalize numbers can shave $50 to $150 a month. On smaller deals, that alone can move DSCR by 20 to 30 basis points. Pair that with interest only and you have got a powerful 1-2 punch. How I work with investors nationwide with a New York, New Jersey, and Connecticut edge. I lend nationwide, but I live in these tri-state nuances: homeowner associations, flood maps, commute premiums, student and medical corridors. Send me the address, target rate, and rough budget. I will run DSCR loan scenarios. Fully amortized versus interest only, 30 versus 40 years, different points and prepayment structures, and give you a clean decision path before you go hard on your deposit. Quick recap: 1, underwrite rent to average or loan not the high. 2, model DSCR loans levers, interest only, 40 years, point and down payments before you submit. 3, match your prepay to your exit strategy. 4, hold 9 to 12 months of reserves across your portfolio. 5, favors 2 to 4 units, vet condos, HOAs, STRs, and mixed use carefully. And the bonus: work with a lender who communicates, knows DSCR loans, and actually specialize in it. 7, lock insurance earlier. It is easiest DSCR booster. Thanks for watching. If you are ready to take the next step or you just want help figuring out the smartest financing for your next deal, call or text me. I will help you turn today's challenges into tomorrow's cash flow with smart DSCR loan strategies.
If you want to learn how to use financing to grow your portfolio, check out my DSCR loan tips and tricks playlist. Inside, you'll find powerful strategies, lender insights, and real-world tips to help you close more deals and maximize your cash flow.